Are you interested in knowing that China's economy will become the world's leading economy in the coming years? Before 1979, China used the term central planning, commonly called command economics. Mao Zedong was the leader of the country at the time. The government ran and controlled a big part of the country's economy. It did this by setting production goals, putting price controls in place, and distributing resources across most of the economy. Hello there guys, welcome back to the channel and greetings. Today's video will discuss that China primarily focuses on eradicating the competitive countries in the economic reforms, so be sure to stay focused. The growth of Chinese economy. During the 1950s, all of China's small family farms were managed and joined together to form larger communities. In the 1960s and 1970s, the central government invested much money into both organizational resources to help mass production move quickly. The size of these investments was huge. So by 1978, more than 3/4 of industrial production was done by centrally controlled, state-owned companies that followed central planning output targets. From 1953 to 1978, the Chinese government says that China's real GDP per capita grew by an average of 6.7% per year. What is driving China's fast economic growth? Financial experts often point to heavy investment, backed by a lot of domestic savings and foreign investment, and accelerated productivity growth as the two main reasons for China's fast economic growth. Policy changes to the economy made it work better, leading to more goods and more money being available to invest in the economy. China has always had a high savings rate over its long history. When the reforms were first implemented in 1979, the share of domestic savings in the GDP was 32%. As a result, China has the highest gross savings rate as a percentage of GDP. China has kept investing at a high level because it has saved much money at home. China's gross domestic savings are much higher than its domestic investments. This makes China a big net lender around the world. Several economists think that productivity gains, also called utilization, have been a primary reason for China's fast economic growth. Most productivity gains came from moving resources to more valuable purposes. Changes in agriculture, for example, led to more production, which freed workers to look for jobs in the more productive manufacturing industry. Still, as China's technological development began to catch up with that of developed economies, and as a result of its implementation of foreign technology, it is becoming more productive. A look at how China's economy is doing. Since the Chinese economy is multiplying, many economists wonder if China could one day pass the US and become the world's leading economic power. The actual size of China's GDP has been a source of disagreement among economists for a long time. IMF analysis suggests that China's GDP in 2018 was $13.4 trillion when judged in nominal US dollars and using nominal exchange rates. This is about the same size as 65.3% of the US economy. In 2018, China had a nominal GDP per person of $9,608. This was 15.3% of the level in the US. Many economists believe that transforming statistics from China to other countries into US dollars using marginal exchange rates doesn't show the proper size of China's economy or the country's living standards compared to those of the US. Nominal exchange rates show how the prices of other currencies compare to the value of the US dollar. These numbers do not consider the price and quantity of goods in other countries. For example, suppose a visit is paid to China and changing one US dollar into Chinese currency. In that case, individuals could buy more goods and services than they would in the US. This is because the median price of products in China is much lower than in the US. China is the most essential place to make goods in the world. The World Bank says that China has crossed Japan to become the biggest producer in the world. The numbers come from the years 2006 and 2016. The data on international gross value added to show how much the country's manufacturing was good enough to justify that means they eradicate the value of intermediate inputs and raw materials used in production. In 2016, China's production had a 49.2% higher gross value added than that of the US. China's economy is much more affected by manufacturing than the US economy. In 2016, manufacturing made up 28.7% of China's GDP, while only 11.6% of the US GDP came from industrial production. The retail trade structure of goods in China. Due to economic reforms and the opening up of trade and investment, China has become a significant economic power. Between 1979 and 2018, the value of Chinese exports went from $14 billion to $2.5 trillion, while the value of Chinese imports went from $18 billion to $2.1 trillion. Due to China's rapidly growing trade flows, many countries now see China as one of their most essential and often their largest business partners. China is proud to be one of 130 countries' most important trading partners in 2013. From 2000 to 2008, China's exports of goods grew by an average of 25.1% per year, while its imports grew by an average of 24.2% per year. But because of the global financial crisis, exports and imports from China fell by 15.9% and 11.2% respectively. Between 2010 and 2011, China's exports went up by an average of 25.8%, while imports went up by an average of 31.9%. The top trading partners for China. China's official trade data for 2018, with its 7 biggest trading partners, include the 28 countries that make up the European Union, the United States, the 10 countries that make up the Association of Southeast Asian Nations, in addition with Japan, South Korea, Hong Kong, and Taiwan. The United States and ASEAN are leading their positions in China's top 3 export markets, while the EU 28, ASEAN, and South Korea were its top 3 import markets. China had significant trade surpluses with the US, $282 billion, Hong Kong, $274 billion, and the EU 28, $129 billion. But it had significant trade deficits with Taiwan, $112 billion, and South Korea, $74 billion. China's pay rate and labor cost advantages may have gone up because the number of working-age people has gone down. In 1990, the average monthly wage in China was $55, while the average monthly wage in Vietnam was $32, and the average monthly wage in Mexico was $221, $24. But in 2018, the average monthly wage in China was $990. This was 316% higher than the average wage in Vietnam, $238, and 158.5% higher than the average wage in Mexico, $383. From 2007 to 2018, the average monthly wage in China went up by 263%. In the 2019 Business Climate Survey from the American Chamber of Commerce in China, rising labor costs were listed as the second biggest problem for U.S. companies in China. 56% of recipients cited them as their most significant concern. Industrial policies and state-owned businesses. The World Bank states that China has been one of the most active users of industrial policies and administrations worldwide. According to the State Council of China, there are presently 150,000 SOEs at the national and local levels of government. China's SOEs may be responsible for up to half of the country's non-agricultural GDP. Also, even though the number of SOEs has decreased significantly, they still control many industries, such as oil and mining, telecommunications, utilities, transportation, and other industrial sectors. They are shielded from competitive pressure. Even though there are a lot fewer SOEs than there used to be, one study found that 50% of China's top 500 manufacturing companies and 61% of its top 500 service sector companies were state-owned enterprises. The Belt and Road Project is going to be started by China. China started the Belt and Road Initiative, also called One Belt, One Road, in 2013 to boost economic cooperation and accessibility with China's neighboring friends and trading partners in Asia, Africa, Europe, and other areas of the globe. This includes infrastructure, trade, and financing. The Belt and Road Initiative encourages people to work together. It has a clear goal: to improve infrastructure and connections, strengthen economic policy coordination, improve the alignment of planning processes, and boost linked development so that everyone can be wealthy. Even though it started in China, this project is good for the world. It has strong roots in the past, but looks to the future for direction. It focuses on Asia, Europe, and Africa, but partners from other continents are welcome to join. However, thought that putting the Belt and Road Initiative into action will lead to the creation of a more significant and more energetic forum for cooperation in the Asia-Pacific area. Why China is likely to overtake the U.S. as the world's largest economy in the coming years. In nominal U.S. dollar terms, China would pass the U.S. and become the world's largest economy by around 2030, but it would never get a big lead, and by the middle of the 20th century, it would be much poorer and less constructive per person than the United States. Most studies have found that China's market will continue to grow significantly at about a rate of 5% per year until the year 2050. That's all we have for you today. Take a look at how you can predict the economic countries. If you enjoyed this video, give it a thumbs up. If you don't want to miss any future videos, subscribe to the channel and switch on notifications. First and foremost, what do you think about China and its preceding infrastructure around this globe? Please participate and share your thoughts in the comments section below.